What is the current interest rate and what are rates doing right now? Those are two of the most commonly asked questions by my clients. And it's not only important to know what moves rates, but also how to read them. If you Google mortgage rates, you're going to be overwhelmed with ads and offers by a bunch of different lenders. But unfortunately, that doesn't mean a whole lot to you unless you know how they're arrived and whether or not you qualify for those rates. So what moves mortgage rates? First, it's important to note that mortgage rates move in eighths. So, for example, if we start at 4%, we could move up to 4 1/8 to 4 1/4, or we could move down to 3 7/8 or 3 3/4. So mortgage rates move in eighths. If you see a weird funky number like 4.72, 4.93, or even 4.99, that's the APR, or annual percentage rate, which is different than your actual interest rate. Your monthly payment is based on the interest rate, while the APR will reflect that rate and all of the loan costs associated with it and show it as a percentage. It's also important to know that it's not really the rates that change so much as it is the pricing that's associated with those rates. When the pricing is affected too much, either positively or negatively, that's when the actual interest rate will move. And did you know that you can really get any rate that you want? As an example, let's say today you could qualify for 4% for absolutely no points. And you could get 3.875%, but it would cost you about a quarter point to do so. So on a $200,000 loan, that would be $500. That lower eighth of a percentage point would actually save you $15 a month. So by spending $500, if you knew you were going to live in the property for 33 1/3 months minimum, you'd actually be saving money. On the flip side of this example, you could actually raise the rate to 4 1/8, and you would actually get that quarter percent or $500 as a lender rebate to credit your closing costs. And there's many reasons that people choose to do things like this. So again, on day one, 3.875 might cost you a fee. 4% would not cost you anything, or would be par, if you will, and 4 1/8 would be above par. On day two, if pricing improves by 25 basis points, then 3.875 becomes your new par rate, and 3 3/4 technically should cost you only $500 compared to the $1,000 that it probably cost you the day before. Okay, Andy, so what the heck moves my pricing? On any given week, there are a number of different market reports released, like the jobs report, unemployment, and inflation numbers, that will affect interest rates. You also might find links to different articles and hear different experts talk about the 10-year Treasury bond and how interest rates will typically follow in this market direction. When the value of the bond is up, rates are down, and when the value of the bond is down, rates are up. And while you can look at that indicator, or where the Dow and Nasdaq are, the theory is that when the economy is good, investors will pull their money from safe investments like bonds and put them into stocks and other high-yield securities. All of these indicators can give you an overall temperature of where interest rates might be headed. However, theory is rarely reality, and the market rarely plays fair. The only true indicator of where mortgage interest rates are going is the Fannie Mae coupon. The Fannie Mae coupon is a mortgage-backed security and gives lenders a benchmark on where to set their interest rates. This is the only indicator that I look at. You don't hire a loan officer to quote you a rate sheet. You choose to do business with a professional consultant like myself who knows how to read these markets and knows how to take advantage of them and tell you when to lock and when to float. call me and let's have a conversation and see if we can possibly lower your interest rate as well. Thank you.